Constantinople, on May 29th, 1453. You're a merchant in the world's richest city. Your warehouse holds 50,000 gold hyperpyra, the Byzantine Empire's currency that's dominated trade for 1,000 years. 1,000 years of stability, more reliable than stone, more trusted than the sunrise. Then the walls fall. By sunset, your currency is worthless. The Byzantine hyperpyron, which financed crusades and built cathedrals, becomes scrap metal overnight. Merchants who held gold coins still had wealth. Merchants who held paper promises became beggars. The city didn't just change hands. An entire monetary system, 1,058 years old, vanished in 24 hours. Here's what they don't tell you in economics class. Currency death isn't the exception, it's the rule. Since 1700, there have been 735 documented fiat currencies. 599 of them no longer exist. That's a 77% failure rate. The ones still standing, most are on life support. The British pound has lost 90.5% of its purchasing power since 1900. The US dollar has lost 96% since 1913. So here's the question that actually determines whether you build generational wealth or watch it evaporate. When the currency you're betting your life on joins the graveyard, what survives? I pulled the financial autopsies from every major collapse since 1450. The Spanish Empire, the French Revolution, Weimar Germany, the Soviet Union, Argentina, Zimbabwe, Lebanon. Not opinion, not theory. Archaeological level evidence of what preserved purchasing power when governments failed their most basic promise. By the time you finish this, you'll know the 5 assets that survived when empires burned. And you'll understand why 99% of investors are positioned exactly backwards. Let's go. First, understand the pattern. Because currency collapse isn't random, it's mathematical, and it follows the same sequence every single time. Stage 1, the government makes promises it can't keep. Pensions, welfare programs, military spending, debt obligations. The math doesn't work, but nobody wants to admit it. Stage 2, revenue can't cover commitments, so they borrow. Debt accelerates faster than GDP growth, the gap widens. Stage 3, lenders lose confidence, borrowing costs spike, so the government does the only thing it can, it prints. Currency creation accelerates. Stage 4, velocity increases. People start spending immediately because holding cash means losing value. The money supply explodes and purchasing power collapses. Stage 5, total loss of confidence. People abandon the currency entirely. Hyperinflation or outright rejection. The currency dies. This exact sequence destroyed the Spanish real in the 1600s after New World silver flooded markets. France's assignat after the revolution, backed by confiscated church lands, it lost 99% in 5 years. Austria's krone after World War I, from 16 to the dollar to 70,000 in 3 years. The Soviet ruble in 1991, 67 years of communist economic planning, gone in months. Same pattern, same stages, same mathematical inevitability. So when your currency enters this death spiral, what actually holds value? Let me show you what worked when everything else burned. Number 1, and this might surprise you, not just any land, land with mineral rights attached. Let me take you to Bolivia, 1545. A shepherd discovers silver at Cerro Rico. Within a decade, the Spanish crown is extracting 60% of the world's silver from this single mountain. The city of Potosí grows to 200,000 people, larger than London at the time. Here's the critical insight. Families who owned land with silver deposits became dynasties. Families who held Spanish currency became poor as silver inflation destroyed purchasing power across Europe. Fast forward to the Soviet collapse. When the ruble disintegrated in 1991, 1993, what asset class survived? Resource extraction rights, oil fields, natural gas, mineral deposits. The oligarchs who became billionaires didn't get rich holding rubles. They controlled physical assets that generated revenue in hard currency. Look at Venezuela right now. The currency is worthless, but land with oil reserves, still valuable, because oil sells for dollars on international markets, not believers. The mechanism is simple. Mineral rights generate cash flow denominated in global commodities. Oil sells for dollars, gold sells for dollars, copper sells for dollars. When your domestic currency collapses, mineral-producing land gives you access to hard currency revenue. But, and this is critical, location matters brutally. Mineral rights in a politically unstable jurisdiction can be seized. Russia nationalized Yukos, Venezuela nationalized oil fields, Zimbabwe seized mines. The winning strategy, own land with mineral rights in stable jurisdictions with strong property law, Canadian mining properties, Australian resource rights, American oil leases in states with constitutional protections. These survived when governments collapsed around them. Number 2, transportable commodities, specifically assets that are universally valued, high value to weight ratio, easily moved across borders, cannot be printed by governments. Gold is the obvious one, and we'll get to it. But throughout history, other commodities filled this role. During the Roman Empire's collapse in the 5th century, spices from the East became currency. Pepper was literally used to pay rent and taxes. Why? It was transportable in demand and couldn't be debased by politicians. In World War II, POW camps, cigarettes became money. Not because prisoners smoked, because cigarettes had the properties of currency, divisible, durable, recognizable, scarce. When Red Cross packages arrived with thousands of cigarettes, it caused inflation in the camp economy. Remove cigarettes, deflation. Perfect proof that anything scarce and transportable can function as money. Jump to modern times. In Zimbabwe's collapse, fuel became currency. People hoarded gasoline and diesel because it was transportable, valuable, and the government couldn't print more of it. Small-scale traders made fortunes buying fuel with worthless Zimbabwe dollars and selling for hard currency. But here's the evolution. Today, the king of transportable commodities is still gold. An ounce fits in your pocket, worth $2,000. Try transporting $2,000 worth of fuel, or pepper, or cigarettes. The value-to-weight ratio makes gold unbeatable. During the 2001 Argentine crisis, wealthy families who saw it coming converted pesos to gold and stored it in Uruguay or Switzerland. When the Corralito froze bank accounts, these families still had access to wealth. Families who trusted the banking system lost 75% overnight when peso deposits were forcibly converted to devalued currency. The brutal lesson: transportable commodities let you move wealth across borders when domestic systems fail, but only if you actually hold them physically. Paper claims to commodities evaporate when the issuing institution collapses. Number 3, foreign real estate, not domestic property. Foreign. Here's what most people miss. When your domestic currency collapses, local real estate prices might rise in nominal terms. But your purchasing power still dies if the property generates rent in worthless local currency. Let me show you how this plays out. Argentina, December 2001. Middle-class family owns a nice apartment in Buenos Aires, valued at 200,000 pesos. With the peso pegged 1.1 to the dollar, that's $200,000 US. The peg breaks, the peso crashes. Within months, it trades at 3-1, then 4-1. By 2002, the apartment's still worth 200,000 pesos nominally. But in dollars? Now worth $50,000. The family lost 75% of their wealth without the property value changing in pesos. Meanwhile, their neighbor bought a small apartment in Miami for $80,000 in 1998. When the crisis hit, the Miami property is still worth $80,000 in dollars. In relative terms, the neighbor preserved wealth while the first family was destroyed. This pattern repeats everywhere. Chinese citizens buying property in Vancouver, Los Angeles, Sydney. Why? Because if the yuan ever collapses or capital controls tighten further, they have wealth denominated in Canadian dollars, US dollars, Australian dollars. Russians buying London property, Lebanese buying Paris apartments, Venezuelans buying Miami condos. It's not speculation, it's survival insurance. The mechanism is jurisdiction arbitrage. You're moving wealth from a risky political and monetary system to a more stable one. When Turkey's lira crashes, a Turkish citizen with an apartment in Berlin preserves purchasing power. A citizen with only Turkish property watches real wealth evaporate even as nominal prices rise. Critical qualifier: foreign real estate works only in jurisdictions with strong property rights, rule of law, stable currency, protection from seizure, access to rental markets that pay in hard currency. Buy property in another failing state, and you've just doubled your risk. But own real estate in Switzerland, Singapore, or stable parts of the US, you've created a wealth anchor outside your home system. Number 4, this one separates people who understand modern finance from people who don't. Ownership stakes in multinational corporations. Not domestic companies, multinational corporations with revenue streams in hard currencies. Let me show you why this works. Venezuela, 2015. You're a wealthy Venezuelan with 2 investment options. Option A, you own shares in CAN TV, Venezuela's domestic telecom company, earns 100% of revenue in bolivars, operates entirely within Venezuela. Option B, you own shares in Apple, earns revenue in dollars, euros, yen, operates globally. The bolivar collapses from 6 per dollar to over 1 million per dollar. CAN TV's stock price rises in bolivars. Sounds good. But the company's revenue is worthless bolivars. Its costs for imported equipment skyrocket in bolivar terms. Real profitability collapses. In dollar terms, CAN TV shareholders are annihilated. Meanwhile, Apple keeps earning dollars, euros, yen. The bolivar collapse doesn't touch Apple's fundamental value. Venezuelan shareholders in Apple preserve wealth completely. This isn't theoretical. It's playing out right now across emerging markets. Turkish investors holding Turkish bank stocks versus American tech stocks. Lebanese investors holding Beirut real estate companies versus Swiss pharmaceuticals. When the local currency collapses, local equities denominated in local earnings die with it. Multinational equities survive. Historical proof. During the 1997 Asian financial crisis, the Thai baht collapsed from 25 to 56 per dollar. Thai companies with purely domestic revenue streams saw their dollar-adjusted values crushed. But Thai investors who owned shares in U.S.-listed companies through international brokers preserved wealth. Same in Russia, 1998. The ruble crashed from 6 to 21 per dollar. Russian oil companies with export revenue maintained value because oil sold for dollars. Domestic Russian retailers collapsed because they earned rubles but faced dollar-denominated import costs. The key distinction: revenue source determines survival. A company's stock is ultimately a claim on future earnings. If those earnings are in a currency that's dying, the stock dies too. If earnings are in stable currencies or globally traded commodities, the stock survives. Modern application: if you live in a country with currency risk, holding S&P 500 stocks through a U.S. brokerage account is survival insurance. Those companies earn globally diversified revenue. When your local currency crashes, you still own claims to dollar-denominated earnings. Number 5. The most valuable asset that survived every collapse in human history. And it's the one nobody talks about because you can't buy it on a stock exchange. Portable skills and professional networks. Let me take you to Germany, 1945. The country is rubble. The Reichsmark is worthless. Industry destroyed. Banking system collapsed. Total economic annihilation. 2 men. Both lost everything physical. Same starting point. Man A was a landlord. His wealth was real estate. His income was rent collected in Reichsmarks. When the currency died and his buildings became rubble, he had nothing. No skills. No way to generate value. He remained poor for decades. Man B was an engineer. He lost his house, his savings, everything physical. But he still had technical knowledge. He could design machines, read blueprints, solve problems. Within months, he was working for Allied reconstruction efforts, earning hard currency. Within years, he was running a manufacturing firm. The difference wasn't luck. It was human capital. Skills cannot be bombed. Knowledge cannot be inflated away. Professional expertise transcends currency systems. Fast forward. Soviet Union collapses, 1991. Millions lose everything. But Soviet scientists, engineers, mathematicians, and despite losing all physical wealth, found work internationally. Their skills were portable. American tech companies hired them. European research institutions offered positions. Russian programmers became highly paid Silicon Valley employees. Lebanon, 2019 present. Currency crashes 98%. Doctors earning Lebanese pounds watch their real income evaporate. But Lebanese doctors with international credentials, they emigrate to Gulf states, Europe, North America. They rebuild their wealth in dollars, euros, dirhams. Same medical skills, different currency system. Venezuela, ongoing. Engineers, doctors, architects, accountants, anyone with internationally recognized skills, leave and earn hard currency abroad. Manual laborers without portable skills remain trapped in a failed economy. The data proves this. Research on refugee populations shows that pre-migration education and professional credentials are the strongest predictor of economic recovery after displacement. A Syrian doctor who fled to Germany in 2015 with zero physical wealth but medical credentials is economically successful by 2020. A Syrian shopkeeper with the same starting point struggles because retail experience doesn't transfer across borders and languages. This applies even if you never physically relocate. During currency crises, people with skills that generate hard currency revenue survive. Web developers who work for U.S. clients and receive payment in dollars. Graphic designers serving international markets. Translators paid in euros. Consultants billing in stable currencies. The strategic implication: invest in skills that are internationally recognized, in demand across borders, capable of generating income in hard currencies, not tied to a specific political jurisdiction. Medicine, engineering, software development, finance, mathematics, languages. These skills let you earn outside your domestic economy, regardless of what happens to your currency. And professional networks compound this. German Jews who fled the Third Reich and rebuilt successful lives in America didn't do it alone. They had professional connections who vouched for them, hired them, partnered with them. Networks are portable wealth that opens doors when everything else is closed. Quick pause. If this is changing how you think about wealth preservation, hit subscribe. I forensically analyze financial history so you see the patterns before they crush you. Unlike financial advice designed to sell products, this is raw pattern recognition. Free. Unlike economic education in a system that benefits from your ignorance. Now, let's talk about what failed, because avoiding wealth destruction is as important as preservation. The number one wealth destroyer across every currency collapse in history: cash and bank deposits in the failing currency. This seems obvious, but most people still get destroyed by it. Why? Because normalcy bias is a killer. Germany, 1923. If you held cash marks or bank deposits in marks, you lost 100%. Total annihilation. A lifetime of savings became worthless in months. Hungary, 1946. The peso experienced the worst hyperinflation in recorded history. Prices doubled every 15 hours at the peak. Bank deposits evaporated faster than ink could print new currency. Families who saved diligently for generations watched it all vanish. Yugoslavia, 1994. The dinar collapsed so fast that stores changed prices multiple times per day. By January 1994, inflation hit 313 million% monthly. Pensioners receiving fixed dinar payments starved. Their pensions still came. The currency was just worthless. Zimbabwe went to 8. Bank deposits in Zimbabwe dollars became functionally zero. The government printed a $100 trillion note. It couldn't buy a bus ticket. Venezuela, ongoing. Savings accounts in bolivars lost 99.99% to purchasing power. A person with 1 million bolivars in 2013, enough to buy a car, can't buy coffee in 2024. The mechanism is mathematical. When currency supply explodes, each unit's purchasing power collapses proportionally. Your account balance number stays the same. The value disappears. Modern trap. High-yield savings accounts and risky currencies. Turkish banks offered 50% interest on lira deposits in 2023. Sounds attractive. But the lira lost 60% against the dollar that year. You earned 50%, but lost 60%. Net result? Still poor, just with bigger numbers. The lesson is brutal and simple. Being a creditor to a failing monetary system is financial suicide. Bank deposits are loans to the bank. If the currency collapses, the loan is repaid in worthless paper. Number 2 on the destruction list, government bonds denominated in the collapsing currency. This kills sophisticated investors who should know better, because government bonds are supposedly safe, right? France, 1790s. Revolutionary government issued assignats, bonds backed by confiscated church property. Initially traded at face value, the government printed more and more. By 1796, they traded at 0.5% of face value. Bondholders lost 99.5%. Austria-Hungary, 1918. Empire collapses. Government bonds become worthless as the political entity that issued them ceases to exist. Bondholders receive nothing. Germany, 1923. Weimar bonds paid in marks. As the mark hyperinflated, bond payments became worthless even though they were made on schedule. Receiving 1 billion marks when bread costs 200 billion is mathematical zero. Russia, 1998. Government defaulted on domestic ruble-denominated bonds. Bondholders lost 70-90% immediately. What remained became worthless as the ruble crashed. Argentina, 2001. Government bonds forcibly restructured. Bondholders lost 70% nominal value. Remaining payments made in devalued pesos, creating additional real losses. Total destruction exceeded 90%. Greece, 2012. Voluntary restructuring forced on bondholders. Private creditors lost 53.5% nominal value immediately. With the subsequent currency crisis pressures, real losses approached 75%. Lebanon, 2020. Government defaults on Eurobonds. Domestic pound-denominated bonds become worthless as the currency collapses 98%. Bondholders get pennies on the dollar after years of legal disputes. The pattern is identical every time. Government bonds are a promise to pay in the government's currency. When the government proves unable or unwilling to maintain currency value, bondholders are first in line for destruction. Why? Because governments control the printing press. They can always make nominal payments. They just pay in currency that's worthless. Legally, they fulfilled the contract. Economically, you're ruined. This is happening right now. Turkish government bonds yield 40-50%. Lebanese bonds trade at massive discounts. Venezuelan bonds are near zero. Investors buying these are betting that the currency stabilizes. History says they're wrong. The yield isn't compensation for risk. It's a warning signal. Number 3, ownership stakes in businesses that operate exclusively in the domestic economy with no hard currency revenue. This destroys small business owners who did everything right, except diversify currency exposure. Example, Venezuela, 2010-2020. Family owns a successful restaurant in Caracas, earns bolivars, pays expenses in bolivars. Real estate paid off, business generating strong cash flow in local currency terms. As the bolivar collapses, several things happen simultaneously. Imported ingredients become unaffordable. What cost 100 bolivars now costs 100,000. Revenue can't keep pace with input cost inflation. Customers, earning bolivars, can't afford higher prices. The business margin compresses. Labor costs spike in bolivar terms as workers demand raises to keep pace with inflation, but the raises still can't match real inflation. Workers quit. Quality suffers. Even if revenue grows 1,000% in bolivars, real purchasing power collapses because costs grow 10,000%. The business is nominally profitable, but economically dying. Meanwhile, the owner's nephew, who started a software company serving U.S. clients in 2010, is thriving. Same country, same currency crisis, different revenue source, He bills in dollars, costs in bolivars. As the bolivar crashes, his real profitability explodes. He's paying workers in a depreciating currency while earning in a stable one. This played out in every crisis. Weimar Germany, businesses serving domestic markets died. Export manufacturers thrived. 1990s Russia, domestic retailers collapsed. Oil and gas companies with export markets survived. 2001, Argentina, local services died. Agricultural exporters prospered. The brutal lesson: a business is only as stable as its revenue currency. Earn in a dying currency, die with it. Earn in hard currency, survive regardless of domestic conditions. So where are we seeing these patterns now? Because pattern recognition only helps if you can identify the setup before it executes. Argentina, inflation exceeding 200% annually. Peso collapsed from 20 per dollar to over $1,000 in 4 years. Citizens converting to dollars immediately upon receiving peso wages. This is stage 4 behavior. Currency substitution has begun. Turkey, lira lost 75% against the dollar in 5 years. Capital controls tightening. Citizens buying gold and foreign real estate. Stage 4. Egypt, pound devalued 50% in 2024 alone. Foreign reserves depleting. IMF bailouts accelerating. Multiple exchange rates indicate loss of control. Stage 3 approaching 4. Pakistan, rupee collapsed from 100 to 280 per dollar in 3 years. IMF dependency. Reserves barely covering 2 months of imports. Stage 3, and then there's the question nobody wants to confront: the United States. $38 trillion in debt. Annual deficits exceeding $2 trillion. Debt service costs now higher than defense spending. Entitlement obligations completely unfunded. The math doesn't work. But the dollar is the reserve currency. So was the British pound. In 1900, 60% of global trade settled in pounds. By 1950, it was under 10%. Sterling went from global reserve to regional currency in half a century. The dollar's share of global reserves dropped from 80% in 1977 to 65% today. That's not stability, that's erosion. Same trajectory Britain followed. BRICS nations actively building alternative payment systems. China and Russia settling trade in yuan and rubles. Saudi Arabia accepting yuan for oil. These aren't headlines, these are structural shifts in the monetary order. Does this mean the dollar collapses next year? No. Does it mean the pattern is visible if you're willing to look? Absolutely. Here's the brutal truth nobody tells you. Currency collapse isn't a black swan. It's not a tail risk. It's not a once-in-a-century event. It's the historical norm. Of the 775 fiat currencies created since 1700, 599 are gone. That's 77%. And the ones still standing have lost 85 or 99% of their purchasing power. Your currency, whichever country you're in, will eventually fail. Not might. Will. The only question is whether you'll be positioned to survive when it does. The 5 assets that outlived every currency. 1. Land with mineral rights in stable jurisdictions. Generates hard currency cash flow regardless of domestic currency conditions. 2. Transportable commodities, especially gold, cannot be printed, easily moved, universally valued. 3. Foreign real estate in stable jurisdictions. Moves wealth outside your domestic system's failure zone. 4. Multinational corporate ownership. Claims to earnings in hard currencies, immune to domestic collapse. 5. Portable skills and professional networks. Human capital that transcends currency systems entirely. What went to zero every time? Cash and bank deposits in the failing currency. Government bonds denominated in dying money. Domestic-only businesses with no hard currency revenue. The difference between generational wealth and generational poverty is this simple: diversification across currencies and jurisdictions. A portfolio concentrated in a single country's assets, even if it includes stocks, bonds, and real estate, faces catastrophic risk if that country experiences currency collapse. You're not diversified, you're concentrated in a single currency bet. True diversification means precious metals as monetary system insurance, foreign currency assets to protect against country-specific collapse, multinational equities with global revenue streams, real assets in stable jurisdictions, and most critically, skills that generate value in any currency system. This isn't doomsday prepping, it's pattern recognition. The pattern has repeated 599 times since 1700. It will repeat again. The question isn't if your currency will fail. History answered that. The question is whether you'll see it coming, or whether you'll be the merchant in Constantinople in 1453, holding 50,000 hyperpyra on the day the walls fell. If this forensic analysis changed how you think about wealth, hit subscribe. Drop a fortress emoji in the comments if you're already positioning outside your domestic system. I read every single one. The autopsies are complete. The pattern is clear. The only question is whether you'll act before you become the next case study. Thanks for watching. Now go build a portfolio that survives when currencies don't.